Okay, everyone, welcome to the session. This is a revision session. It's a fast track session where the objective is to touch upon all the concepts, do a lot of questions, and meet y'all to understand your doubts and your schedule and everything. All right. So this program is going to be a bit faster, a bit intense. This 1 month is going to be your, this 20-30 sessions that we have. It's going to be completely dedicated to this. So be prepared for it. At the end of the day, it's going to be worth it, right? Now, let me start first with the book. Okay, as I said, the book, I have just recently launched this book and I've got tremendous response. I never thought that people would be buying this book from so many places. So I launched the book and I had to immediately launch it during my last exam when students wanted a summary. And fortunately, the last exam, the recent exams, all the candidates who were appearing for the first time, they all passed because Institute gave amazing result this time. This is a big difference in terms of result from the last time. Okay, so that's a good news. Now, that was good news for them. Is it a good news for me or a bad news for me? Stop thinking about it. Don't think about it. Okay. Now, this book is into two parts. Why into two parts? Because the first part has the five in your AM session in exam. You have the five topics: QM, economics, financial statement analysis, ethics, and corporate finance or corporate issuers, right? These five topics are going to be in your morning session, right? Initially, there were four. Now they put one more topic called corporate issuers from the PM session to the AM session. The second book has the remaining five topics. In CFA level 1, the flow of topic is very important. It's very different in all the levels, but in level 1, quantitative methods and FSA, financial statement analysis, are the core foundation. Okay, so we'll definitely begin with that. We'll try to build our foundation with these two topics in the couple of days. How are we going to proceed? Well, we are going to cover this entire revision book. Now, what is there in the revision book? In the revision book, I've covered all the concepts that you need. Number one, plus all the formulas. However, many of you all, because we were short of stock and I've already ordered a lot of bulk books because I'm already short of books. So the first edition that I immediately launched is what you have right now. However, there are some minor, corrections or some additions that I realized. So for those, I have already given you a link. If you open that link, right, you can access that link anytime. Now, this link is where you have the same content as you have in the book, but it's in the reading wise form. Now, here, just to give you an example, the first reading that you have in quants, rates and returns. Everyone with me on this reading? In your book, Okay, in your book, if you open the page, on the first page itself, you will quants, where the book starts. Okay, this is the first page where you have rates and returns. Everyone with me on this page, right? Okay. Now, see, some of you all must have got a book from my first edition. There are some minor changes and some addition that I thought that you all should have. So what I've done is that all those additions, I've shared you this link. You can see the additions in that link as well. Now, whatever is the new thing or there is a change in something, okay, all of those things are highlighted by me in that OneNote link. So what do you see highlighted in the first case? This nominal return, nominal risk-free plus set of risk premium. This might be an addition. This anything that I've highlighted in yellow is an addition in your book. So what you can do, two things. While we are in the lecture, at that time only, you can add it in the book itself. Number one thing. Or second, after the lecture, you always have the OneNote link with you. So you can always copy paste these changes in your digital notes also. Clear? So the digital notes that I've shared you already has these changes, correct? The physical book that many of y'all have might not have these changes because it's the recent edition. In that case, whatever are the changes I've highlighted in the OneNote also, and on my screen also, it's in yellow, correct? So whatever is in yellow, those are the changes. However, during the lecture also, I will discuss about them. Is that clear, everyone? Okay. Do respond by putting something on the chat, by a thumbs up, or by just yes or why, whatever you want. But please do respond so that I know, because sometimes what happens is that I'm speaking on the session for 30 minutes and then I saw my calls and all, the video was not popping up. So please keep responding. Let's be energetic. I know you all are probably tired from your work and all, but everyone, right? Clear? So you have OneNote link, the digital, the latest one. Now, why the OneNote link? Because whatever changes or addition or something, if I want to add, I can do it, and it's cloud-based, so it is automatically uploaded. So save that link, number one. Second, you have the copy of the book itself. So we are going to study from the book. I actually love the physical book always, and I'm sure you will also love the physical book. It's well designed by me. So I hope you all will like the book. And this book summarizes everything because many things are scattered in your notes. However, I do have your notes also. So in case at any point, if I require something, we can pick it up from there also. Don't worry. Clear? Right? After doing this, you do not have to refer any other notes. See, level one, concepts and questions. We have to do a lot of questions. But to do those questions, sometimes we might miss the concepts here and there. So what is important? A summary of all the concepts at one place. That is what this book is, number one. So we are going to revise all the concepts. Now the process is, as soon as I finish the first, so we are starting with quantitative methods, and that's the flow it should be. Now, as soon as we finish the first reading, I'm going to do some questions with you all in the class of the first reading itself. Got it? We will be solving around 8 to 10 questions of each reading. So overall for QM, we'll be solving around 100 plus questions. Same way for FSA, for corporate and so on. So by the end of the 10 topics, you all will be doing with me in the class around 800 to 900 questions. Number one. Second, along with this, when we meet on the intervals, that is after QM and FSA, when we meet, at that time, I am going to create an account for you where you will be going and giving the test. Yes, you'll be going and giving a mock test for specific topic. For example, the first mock test, as soon as we finish QM, you will be having at the convenience timing and all details I will share you. You'll go there, log in, and you will give the QM test. Same way, when we finish FSA, in the class, we are doing the questions, but after FSA, you'll be giving the test. It is compulsory for all. And the test, I've kept it on weekends at your convenient timing. So I'm sure everyone is aware that your weekends are dedicated now to CFA and me. Okay, so your weekends are gone. They are with me now. So on your weekends, in the morning, when you freshen up and when you're completely charged up, at that time, you all are solving the questions that I've set. And I want the entire class to do it at a specific time together, however busy you are. Let's do it together. So it becomes quite challenging. And when we meet up at that time, I will be discussing those questions and doubts and everything. And I want to meet you all, each one of you all in person, so that I can plan, because see, everyone has a different plan. Everyone has a different way of learning things. It should not be the same for all. So I want to meet all of you all in person, understand what your strategy is, and help you out with clearing those strategy. Okay. Second thing, I'm a bit slow professor. So in case if I take more time, please bear with me. Every extra time that I am doing it is all for you. So don't stress out. I will be telling you all what should be our objective as soon as we complete the revision batch, this 1,000+ questions in the class, around another 1,000 questions that you'll be doing on weekends with me, right? So basically, by the end of the revision batch, you all are covering the entire book, both the books for all the 10 topics, number one. Second, all the formulas. Second, more than 2,000 questions in the class and in the test. Got it? So this is what we are doing. Okay. Now, where are the questions from? I'll discuss all of that when we give the mocks. Okay. Where have I picked up the questions and all? See, the recipe is going to be the same. I'm not going to do anything different from others. It's going to be the same thing. So last 13 years, I've been doing the same process. See, in CFA, ironically, it's not only the hard work, sometimes the luck also matters. And don't worry, we will try to balance out, and our objective is to, because there are some of the things that I tried with my last batch, especially with this revision book and all, and I covered the entire revision book. We did a lot of questions and all, and what was the outcome? The outcome was that all the students passed. Now, I'm not saying it's just because of my process. I don't want to claim that. Of course, the CFA results were also great, but what I the only thing I know is this. I know nothing else, by the way. So what I'm trying to say is that we are going to follow the same recipe. However, when we meet on weekends, I want to understand each and everyone's progress, strength, and weakness so that I can work with you all individually as well. Clear? A lot of discussion, right? Correct? Any questions? Anyone? Any questions related to where are the notes? When the lectures will be uploaded? How will I access? Friends, please ask me all of that after the class. Anything regarding CFA or anything, let me know. Yeah. There are all the versions. Don't worry, I'll share you all everything. Yeah, one more thing. The videos, whatever we are recording, I'll be uploading the videos. Number one thing. Second, whatever I do on the screen, that digital notes also I will be uploading. So you'll be getting access to that as well. Apart from that, anything that you want, always ask me up. Anything that you need from my end, this is not available, that is not available, just don't be hesitant. Directly ask me before, after the lecture. Don't ask me just 5 minutes before the lecture, because at that time, I am also a bit stressed to manage things and all. Okay. Weekends are a Saturday and Sunday, brother. Weekends is not Friday. Weekend is Saturday and Sunday. On Saturday and Sunday, we are meeting and doing all this discussion. Don't worry, I'll discuss all of that in person. Don't worry. Perfect. Everything all set to start QM? Come on. Yeah, I'm seeing the chats. Thank you so much for congratulating me. Yeah. Yeah, thank you. My friend Fadal is here. Is it? Okay. This is Fadal is, by the way, the first person who I know in Abu Dhabi, and the one who's passed all 3 levels and always has been there to support all my students. Thank you so much. And I'm sure he will be highlighting some of his. I'm very happy to see him in the batch. And Fadal, you there?
Yes, hi Kunal, how are you?
Hi. Thank you so much for attending the session. Uh, Everyone is here in the batch. You would want to speak to them, motivate them, because
Honestly, all I have to say is that they're on safe hands. Everything that came from my accomplishments in the CFA is thanks to you, Kunal. Very good teacher, but very detailed. So even if he goes a bit slow, trust me, it pays off in the end.
Fadal, you can also speak in Arabic. Everyone is
Yeah, but I'm sure everyone understands English as well, so don't worry. They get the highlight.
correct. La taklak.
All
Perfect.
right, good luck.
Thank you so much. Okay, so everyone ready to start? Let's start with QM. The first topic, rates and returns. Now see, the first topic, rate and return, and the second topic, time value of money. Now both of these were actually one topic only. Now they separated that. What they have done is that wherever there is calculation with regards to time value, or all the calculations, they've jumbled up and put across in these two topics. Okay, so you might see some equity questions also, some fixed income questions also. So they've mixed up everything: portfolio questions of time weighted return and money weighted return, nominal, real returns, everything they've mixed up in the first two topics. Okay, generally we just do the basics of time value when we do the actual session, and then individual Gordon's growth and all those stuff that they've added, we don't do it now, we do it with equity. However, since we are in the revision patch, we can touch upon each and every concept. Okay, let's start. So first we'll go through all the concepts as I discussed, and then we will be doing questions. Perfect. Everyone is ready with calculator, markers. The thing is that highlight the keywords. Okay. First, what is nominal return? Now, nominal return is also the rate of return at which interest rates, we see interest rates in the market, they are at nominal rate. Nominal rate is a combination of two things: nominal risk-free rate and risk premium. Yes, nominal risk-free rate and risk premium. Now, of course, the formula is nominal rate. Nominal rate, sometimes they also call as nominal interest rate, which is nominal risk-free rate plus risk premium. Now, why these two things are added? Okay, first of all, let's say when you buy a government bond, is a government bond risk-free? Yes, a government bond is risk-free. So the government bonds are sold at a yield or rate of return, which is what we call as nominal risk-free rate. Nominal risk-free rate. Now, what is nominal risk-free rate? Nominal risk-free rate is real plus inflation. Yes, whenever you hear this word nominal, nominal is always real plus inflation. Real rate of return is maybe the rate of your GDP growth rate or the rate of your economic growth rate. Okay, so nominal risk-free rate is a combination of real risk-free rate plus inflation premium. Now, that is the yield for a government bond, or that is the rate of return for a government bond. However, when I look at a corporate bond, is a corporate bond risk-free? Everyone? You can put up your answers in the chat box. Is a corporate bond risk-free, risk-free, risk-free? Tell me. Of course not. Corporate bond is not risk-free. So when you purchase a corporate bond, there is an inherent risk compared to a risk-free bond. That risk is called set of risk premiums. And these risks compared to the risk-free bond are three major risks. The risk of default. Yes, corporates can default. Government bonds hardly default. Second, liquidity premium. So default risk premium, and second is liquidity risk premium. What is liquidity? When you want to sell a bond, which bond is easier, quick to sell? A government bond, because it has huge volume. There are too many buyers and sellers for a government bond. So compared to a government bond, a corporate bond is illiquid. Illiquid means difficult to sell at the fair value. Therefore, compared to government bond, a corporate bond has default risk premium, liquidity risk premium, and of course, there is maturity risk premium. What is maturity premium? The higher the maturity, more is the risk, right? So these three risks combined together, when added to the nominal risk-free rate, we get nominal return. This nominal return will also become your benchmark for interest rates in the later period. Now, in the exam, what they do is that they ask you nominal rate, in nominal interest rate, but just carefully see the difference: nominal rate or nominal risk-free rate. If it is nominal risk-free rate, it includes real plus inflation, correct? But when they only say nominal rate, it is nominal risk-free rate plus risk premium. And there are three risk premium: default, liquidity, and maturity. Everyone clear with this? Correct? Yes. Okay, let's move on. So this topic includes different types of returns. Now, one of the students actually asked me last time that why are there so many returns? Why is there so much of confusion? Well, you invest for 1 month, 1 day, 1 year, multiple years, compound, not compound. Therefore, every product, every instrument is invested for different period with different cash flows, and therefore there are different types of returns. Okay, every return has its own purpose, which we will discuss in the later period. So imagine you are investing in a bond at $100 and selling the bond after 1 year at 105. So you invest at 100 and you're going to sell it at 105. The difference of $5, that is 5%, is your holding period return. So what is holding period return? Ending value divided by beginning value minus 1. However, during the year, if the bond also gives you a coupon of, let's say, $2, right? So now you invested 100. On maturity, you sold at 105. And you got $2 also as a coupon if it's a bond, or dividend if it's a stock, or rent if it's a real estate, right? So when I add income also, then along with ending value plus income divided by beginning value will be minus 1 will be my holding period return for a single period. Okay. However, what if there is a multiple period holding return, right? Holding period return for, let's say, 5 years. In that case, for every period, we calculate the return and we compound it. So let's say first year return is 5%. So how will I compound it? 1.05, 1 plus 5. Second year return is 12%. So I'll do 1.12 compounded. Third year return is, let's say, 3%, or let's say minus 3. Minus 3 from 1 is 0.97. So all of this compounded, when I say compounded, means I will multiply them minus 1. The total will be my multiple period HPR. Okay, holding period, short form HPR. Single period, ending plus income, divide by beginning minus 1. Multiple period, you compound it. Now, this is very much similar to what? To what? This is very much similar to something that is called as geometric mean. Yes. Now, what is the only difference in geometric mean? In geometric mean, what we do? We do the same thing, but we average it. And how do we average it? We average it by making to the power 1 over n. Did you notice the difference? The only difference between multiple period HPR and geometric mean is that geometric mean is also annual returns. However, it is averaged. So geometric mean is also called compounded return, but it is called compounded annualized return. Are you getting me? The difference between compounded return and compounded annualized. Compounded return is when you just multiply all the yearly returns. But compounded annualized is when you average it out by doing to the power 1 over n. So if there is 3-year return, we do to the power 1 over n. This compounded return is also called geometric mean. Everyone with me? Understood the difference? Holding period returns, single period, multiple period, and how is it slightly different from the geometric mean? Clear, clear, clear. Any questions, anyone? Got it? Okay. Now, this geometric mean is generally used when we are going to use compounded returns, when you're going to invest for multiple periods, right? In rare cases, they ask you to calculate multiple period HPR. Only in that case, we are going to compound it, but remember, do not average it. Clear? Got it? So can we just calculate what is going to be 5, 12, and 3% negative? 1.05 into 1.12 into 0.97. Everyone, minus 1 into 100. Can you tell me what is the answer? Yes, answer for this. Everyone. 1.05 into 1.12 into 0.97 equal to minus 1. Are you getting 1.1407? That is, when you do minus 1 into 100, you should get 14.07. Everyone is getting 14.07. Check, 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 check. Right? So 14.07, guys, is the total return of 3-year. Total return. Got it? But if I want to find the geometric mean, what I need to do, again, I will do 1.05 into 1.12 into 0.97. Why? Because it was 3% negative. So on your screen, it should be 1.14. When you have 1.14 here, 1.1407, if you want to average it out, what do we do? To the power 1 over 3. And how do I do that? Can everyone press YX? YX, I'll also show on the screen. YX3. YX3 inverse equal to. YX3 inverse equal to minus 1. And if you do that into 100, you'll get 4.49%. I will now also show you on the calculator. How did I do this? Everyone with me? Everyone's got the answer. Those who have not got, please watch it on the screen. What do I do? Okay, so what was our, everyone, my calculator is visible? Visible, visible?
Yes, yes.
Yes, okay. So see this, we had the first year return was 1.05 times 1.12 times 0.97, right? So you have this on your screen, 1.14. Press YX. Now, where is YX? Just about 9. Y to the power X. And then press 3. YX3. Now, I don't need to the power 3. I need 1 over 3. So after pressing 3, just above yx, there is 1 over x. 1 over x. As soon as you press 1 over x, it becomes 0.33. Press equal to, correct? Minus 1 into 100. You should get 4.486 or 4.49 percentage. Everyone is getting this? Clear? Got it?
Yes.
Yeah, guys, those who have already studied from me, they might find it, Kunal, we've already known this, but there are many who are doing it for the first time, so bear with me. Got it? Yes. So this is what we did. Multiple period holding to geometric mean. Correct? Okay. Now, next. What if a holding period return generally is calculated for what period? Any period. It can be 1 day, 1 year, 10 year, 30 days, 365 days, any days. Holding period. Holding period can be your choice for as long as you hold the investment. However, see, when I'm comparing my trading returns for, let's say, 5 days, I'm comparing that with a benchmark which is annualized. Is it comparable? No, because that's an annualized return and this is 5-year return. So what I need to do is that those 5 days return, sorry, not 5-year, 5 days return, I need to annualize it so that I can compare it with the benchmark. Understood? Yes. I have a question about the decimal. Yes, about the decimal, let me mention. Okay. So on your calculator, everyone, it's better to have 4 decimal. Yes, it is safer to have 4 decimal. I am saying this after considering every aspect. Okay. Of course, how many decimal the answer should be, well, that will be in the choices. So you'll have to select, but I recommend to have 4 decimal. How can you do that? Press second and then there is format dot. Okay. When you press that, it asks you on the screen DEC, decimal. Press 4, enter and clear. Okay. So you will also have 4 decimal with me. Okay. So have 4 decimal. Yes. Clear, everyone? Got it? Okay. So everyone is at 4 decimal with me, right? Okay. Not more, not less. Okay. Yes. So, yes, I was discussing that I have a 5-day trading return, which I want to compare with a benchmark, which is annualized. So what do I need to do? I can't make the annualized return for 5 days. What rather I will do is that I'll make the 5-day return annualized. So what we do is that we annualize the holding period return. So whatever is our holding period return to the power 365 over days. Yes, to the power 365 over days. Don't worry about the questions. We are going to do a lot of questions where I'm going to make you try all of these calculation and I'm going to show all these calculation as well. So don't worry about it. But try to understand why am I using it? Well, I'm using it because there might be some daily returns which I need to annualize it so that I can compare it with some benchmark. Clear, everyone? Right? So many of these formulas that I'm touching upon, you would be wondering, where's the use of it? How to use it? So don't worry, we will be going through, a lot of questions where I'll make you practice that. Got it? Then there is a very small concept of continuously compounded return. Actually, this concept is going to come after a couple of readings, not now, but unfortunately they've put it here as well. So what is continuously compounded? When the compounding frequency is infinite. Now you can't do infinite calculator in your real life. Therefore, we do log natural. So in your calculator, just besides 7, there is a function called ln, log natural, on the left side of 7. Is it visible? Right? So whatever is your holding period return, after that, 1 plus holding period return, if you press ln, it gives you continuously compounded return. Okay? Just understand the technique right now. Application, I will show you when the concept comes up. How to use this? Again, whatever is your holding period return. See, suppose if my holding period return is 1.1407 that I had, just press ln, it will give you 13.16. So what is the outcome of this? So if I continuously compound 13.16, continuously compound means, guys, in a year, when I say semi-annual compounding, how many semi-annual I have in a year? Twice. Quarterly 4, monthly 12, weekly 52, Daily 365. Can anything be much higher than that? Yes, hourly, second wise. Something which is forever compounding is called continuously compounding. It is not possible to calculate manually, and therefore there is something called log natural. So when you press log natural, you get an answer which is continuously compounding, right? More detail of this is what we are going to understand, and its application is actually not going to be in quants, but its application is going to come in fixed income. So when we go to fixed income, at that time we'll actually apply this continuously compounded returns. Got it? Okay. Right now, just understand, okay, what this guy is saying, where is it going to be used, and what is the technique. Application we'll see in the question. Clear? Okay. Yes. Then there are, see, these are individual returns. But if I want to see the average returns, what is the average return statistically called as mean, arithmetic mean? The simplest mean is arithmetic mean, where you take the returns divided by n. So if you have 5-year returns, divided it by n. That is simple arithmetic mean or average. Geometric mean is the compounded return. And when you have multiple securities in your portfolio, and then if you want to calculate portfolio weighted average returns, that is what we call as weighted mean. Yes, weighted mean is nothing but portfolio returns, which we are going to do when we do portfolio calculation. Clear? However, there is one interesting concept related to harmonic mean. Now, harmonic mean is used when? Harmonic mean is only used when you want to find the average cost. You can write it down there. When should I use harmonic mean? Only when I want to find the average cost of something. It is actually not used to calculate returns, but it is used to calculate the average cost of equal investments. Yes, the investment has to be same at regular interval. Only then you can calculate. So suppose if you're going to do 5 investment of $1,000 each in the next 5 months in a stock, so that n will be 5 because you're doing 5 investments at different prices, which will be x1, x2, x3, x4, and so on. So using this formula, we are going to calculate harmonic mean. How do I calculate this? Can I see an example? Yes, we are going to see an example in a moment. Okay, we'll see an example of calculating harmonic mean. And as soon as we calculate harmonic mean, I'll also tell you the relation between geometric mean, arithmetic mean, and harmonic mean. Is there any relationship between all three of them? We'll see that as well. Got it? Clear? Yes. Now, there is a concept which unfortunately CFA Institute has repeated twice. One in this topic and second after understanding the reading of statistics. So when we study mean and then we see normal distribution, where do I see normal distribution? Can you flip couple of pages? And when it comes to reading number 3, statistics measures of statistical measures of asset returns, in that, can you come on this page, mean, median, and mode? Everyone with me on this page? Yes, 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 yes. Okay, what is mean? Mean is the average returns, right? Correct? So it's the sum of the observation divided by n. So what do we do? Summation of the returns divided by n. That is what we call as mean. Correct? Now, suppose if I want to find the average salary of each individual in a country, each individual, then we call it as a population mean. However, if I want to calculate average salary of people from a particular city only, not the entire country, and in that also I want to pull out a sample of 100 people, not everyone, then the mean is called sample mean. Arithmetic mean has two parts: population mean for the entire population, sample mean for the sample. Everyone with me? Right? So mostly for sample mean, you will see a smaller n. For population mean, you see a bigger n. Population mean is denoted by a sign called mu. You see this m and u combination, that's called mu, right? And sample mean is simply x bar, correct? X bar, mu, these are the definitions. It doesn't matter. Here it is actually smaller n, but it doesn't matter. You can write big and small n. It doesn't matter really, because in exam, whatever is the mean you're going to calculate, you're not going to be confused between population and sample mean. Now, what is important here is mean is right in the center. Okay, arithmetic mean. But arithmetic mean is the simple average. What is median? Median is the observation which is in the middle of the item set. After you arranging the set in an order, that order can be ascending or descending. For example, if there are 20 people in queue with different height, what do? We arrange all of them. And the one in the middle is called median, right? Median can be for odd numbers or even numbers. For odd number, it is very simple. Let's say if there are 11 people, then the sixth one, 5 plus 1 divided by 2. Okay. Sorry. Basically 11 plus 1 divided by 2. That is the sixth observation. That will be the median. But the problem happens when there are even numbers. In the case of even numbers, we take the average of 2 in the middle. Okay. Average of 2 in the middle. That will be our median. Very easy to calculate. What is mode? Mode is the number which is repeated the most times. For example, if you have a data set and if there is a number which is repeated twice and no other number is repeated twice, then we say it's unimodal. But what if there are two numbers which are repeated twice? Then we call it as bimodal. If there are three numbers which are repeated twice, we call it as trimodal. Sometimes if all the numbers are unique, none of them are repeated, we call it as no mode. Okay. So mean, median, mode. Now, when you analyze a data set, and what if coincidentally the mean, median, and mode of the data is the same? Well, if this unique thing happens, then we get a distribution which is on this page number. Everyone on this page number? Then we get a distribution which is called as normal distribution. Everyone with me? Normal distribution, which is a bell curve shape. Normal distribution, what is the property of normal distribution? We are going to see that later on. But one of the important parameters of normal distribution is what? Mean, median, and mode all are at the same point. Everyone with me? About normal distribution? Yes. What is one of the unique properties of normal distribution out of many? Mean, median, and mode all are at the same point. Clear? In this case, if you notice, the diagram is symmetric. Symmetric means it is equally distributed on the left as well as on the right. But what if the diagram is not symmetric? When will this happen? This will happen when the mean, median, and mode are not same. And that happens because of some extreme outcomes. These extreme outcomes are called as, can someone ring the bell? What is this extreme outliers called as? Yes, everyone. Extreme numbers, what are they called as? These extreme numbers are called outliers. And because of outliers, what happens? The mean, not the median and mode, but the mean gets skewed or tilt on the left or on the right. Yes. So if the distribution gets skewed, is it normal anymore? No, it is not normal. So any extreme number or extreme value, for example, let's say if I pull out last 20 years returns, the event of pandemic was an extreme event, right? It suddenly brought the entire market down and then it went up. That's a very extreme outcome. Within a year, we saw 100% return up, 100% return down. Many people got heart stroke. So that is a very extreme event. If I put that in the data, it will completely disrupt the data. And what it will do, it will show me a skewed data, skewed. Now we'll discuss about this skewness later, but this skewness, what is the reason of this skewness? What is the reason of this skewness that we were discussing? Can anyone tell me what was the reason of this skewness? Yes. The word. CFA is all about keywords, not statements. Keywords, which should be there in your head. Yes, the reason of this skewness was outliers, extreme numbers. Clear? So what do outliers do? Well, they disrupt the data. And when you look into the financial data, these outliers, they can completely change the outcome. So are these outliers a constant thing? No, they are rare events. They are unusual events. So as an analyst, when we analyze the data, we need to adjust these outliers. How do I adjust these outliers? Number one, either ignore them or you adjust them. When you adjust them, there are two methods which we are going to see in detail later on. First, those extreme numbers, either you remove them, which is called trimmed mean. Trimmed mean is what? When you exclude the outliers. I'll repeat. What is trimmed mean? Trim means, see the meaning of trim. Okay. Trimmed mean is when you exclude the outliers, right? But instead of excluding those extreme numbers, you can also replace them. That is called Winsorized mean. So Winsorized mean, trimmed mean are not new mean. They are adjustment in the mean for adjusting the outliers. Now, don't worry about this. Actually, it should not have been the part of this topic. Unfortunately, it is. It should be the part of that topic only. And therefore, I've kept it here again. Okay. So don't worry. Even if you do not want to memorize it right now, don't worry, ignore it. But I'm just telling you how mean, median, mode are connected. And what if they are not at the same point? The diagram, the normal distribution will be skewed. And the reason of the skewness will be outliers. Everyone with me? Clear? Okay. So with regards to outliers, there are two different types of adjustment that we do in the outliers is either with trim, remove it. Remember the keywords, exclude or replace. Replace, that is Winsorize. No one is going to ask you question in exam, show us and do, do and show us, the trimmed or Winsorize mean. They are not going to ask you to do it. They are just going to ask you that what is it called. They are just going to ask you the name of it. Okay. So you need to know the keywords. I'll repeat, you need to know the keywords. No calculation is required here. Clear? Everyone? Any questions till this point? Everyone? Okay. Now, until now, whatever calculation that we did was for a single stock or a portfolio of stocks. But the general assumption was that you invested once. In real life, when we invest for, let's say, in a portfolio management service, when we give a portfolio for someone to manage, it's not that we just invest one time. We keep on investing multiple times. And also there are multiple cash withdrawals. So whenever there are multiple cash inflows and outflows, in such a case, we need to use a different technique to calculate the overall returns, which considers these cash inflow and outflow timings also. Yes. So for multiple cash inflows and outflows, there are two types of returns, which is money weighted rate of return, which is also called as IRR, and time weighted rate of return, which is nothing but simply the geometric mean. So money weighted rate of return is nothing but IRR. Time weighted rate of return is geometric mean, but the technique of doing both is different. I will show you the technique when we do the questions. This actually is repeated when we do portfolio also. So don't worry, it is repeated again in portfolio. However, here we are going to see an example and do it. Now, before I jump into money weighted and time weighted, please keep in your head, what is money weighted rate of return? IRR. What is time weighted rate of return? Geometric mean. I'll repeat, money weighted rate of return is IRR. Time weighted rate of return is geometric mean. However, just when I show you the technique of doing it in some of the questions, I want you to understand that when we calculate money weighted rate of return, it is very important that you think from the cash flow point of view. Yes, just note it down right now. I'll explain you it later. So when you think of money weighted rate of return, when they ask you, you have to think from the cash flow point of view, cash inflow outflow. When they tell you to calculate time weighted rate of return, you have to think it from the holding period return point of view. Then you don't have to think from the cash flow. You have to think from holding period return point of view. Okay, keep this in your head right now. I'll discuss it when we go into that question, right? Also, what they ask in exam is which one of the two should be used and under what condition? Well, the difference between both is that, of course, the technique is different, so the answer will be different. But which one should I use and when? See, money weighted rate of return is sensitive to the additions and withdrawals. So whatever additions and withdrawals that we do, either you do or the fund manager does it on your behalf, that gets affected in the money weighted rate of return. But time weighted rate of return doesn't get affected by the cash inflow and outflow decision, right? So what they ask in exam, which one is sensitive to cash inflow outflow decisions or withdrawals and additions? Money weighted is sensitive, time weighted is not sensitive to the additions and withdrawals. Keep this in mind. Correct? Right? Now, why in case of time weighted rate of return? See, because it depends whether the fund manager has a control on the cash flow or not. If he has control on the cash flow, if the fund manager has control on the cash inflow outflow decision, then we use money weighted rate of return. But generally, the phenomenon is that most of the fund managers across the world, they do not have a complete control on the cash inflow outflow decision. The inflow outflow decision is with the client, unless and until it's a private equity fund where there is a lock-in. So client can withdraw and invest whenever he or she wants to. So therefore, most of the portfolio returns use time-weighted rate of return because it neutralizes the effect of cash inflow and outflow, which are generally outside the control of the portfolio manager. Why? Because portfolio manager doesn't have a control on putting, you cannot stop the client from putting more funds unless until it's a closed-ended private equity fund. Clear? So conclusion, if they ask you in exam that the manager has control on the cash flow, then we use money weighted rate of return. See, most of the times they will ask you which returns they want to calculate. But if they ask you a theory question that manager has control on the cash flow, we use money weighted rate of return. If the manager does not control the cash flow, cannot control the cash flow decisions, use time weighted rate of return. Everyone with me? Clear, 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 clear. Okay. Any questions, anyone? Anyone? Till this point? Yes. Okay. Don't worry about the break. I will give you the break when we complete this. Okay. Next, in some of the cases, they will ask us to find the difference between gross and net returns. Now, what is the difference between gross and net? Well, the only difference between gross and net is fees. So suppose you are giving your money to manage to a fund manager, right? So the overall returns that has been generated on the fund before deducting the fees are called gross returns. After deducting the fees, and when I say fees, which fees? Which fees? Which fees? Brokerage commission. Are they fees? No. Management expenses, custodial fees, taxes, or any other expenses which are deducted, those are called, all these fees are deducted from the gross returns. And after that, the returns that you get is called net returns. So what is the difference between gross and net returns, everyone? Gross returns are before fees. Net returns are after fees and expenses. Now, there is one very interesting thing. Okay. See, fees. Why do the fund manager charge fees? Because of the service, right? So you pay the fund manager that. So the difference between the gross and the net return is the fees adjustment. But when you give your money to manage to the fund manager goes and buys stocks on your behalf, securities on your behalf. So when they buy security, they do pay commission or brokerage to buy those securities, which is for you. So those are anyways deducted from the gross returns also. So when I say gross returns and net returns, the difference between them is fees. These fees don't include brokerage and commission, because brokerage and commissions are, guys, brokerage and commissions are already deducted before calculating gross returns. So gross returns, when I say gross returns, it already has deducted brokerage and commission. Got it? And after that, you got gross returns. From that, you deduct the fees and then you get the net returns. Clear? Understood? So there is a return from which I subtract the brokerage and commission already, and then I get gross returns. From the gross returns, then I subtract the fees and I get the net returns. Is that clear? Understood? So can you answer me a question, everyone? Ready, ready, ready? Everyone has to put an answer in the chat box. Ready? Everyone? If no one answers, if anyone fails to answer, done. Bye-bye for today. Ready for the answer? Ready for the question? My question is, brokerages or commissions, whether they say brokerage or commission, it's the same thing, are deducted from gross returns or net returns or both? Wow, I'm getting interesting answers. So suppose if they give you brokerage and commissions and they ask you gross returns, are they deducted from it? Yes or no? Yes, they are deducted from gross. But what about net returns? Well, in the net returns also, see, net return comes after gross returns, correct? And from that you subtract the fees. So it's a twist question in exam. If they put something like this, the net return has also deducted brokerage and commission. Understood? Gross return has deducted, net return has also deducted. So the answer should be both. Okay. Gross returns, definitely in gross returns, the brokerages and commission are deducted. And if I see net returns, does the net return not deduct brokerage and commission? Yes, it does, because it has already been deducted from the gross returns. So it's a twist question. Okay. In exam, gross returns, brokerage and commission is deducted. Yes. Net returns, brokerage and commission is deducted. Yes. Management expenses, is it deducted from gross returns? No. From net, when I calculate net returns, yes, it is deducted. Understood? So be careful. When they say brokerage and commission is deducted from gross return, yes. Deducted from net returns, yes. Management expenses deducted from gross returns, no. From net returns, when I calculate net returns, is it deducted? Yes. Clear? You might be saying that, Kunal, why are you confusing? Well, I'm not confusing. I'm talking on the basis of questions that you will come across. Okay, don't worry. Clear the difference, everyone? Next is very easy. When they say pre-tax and post-tax or after-tax. Pre-tax nominal return and after-tax nominal return, well, clearly the difference is due to taxes. So all the taxes needs to be deducted. From pre-tax to after-tax, whatever the taxes that they give, we deduct all the taxes, and then what we get is called after-tax nominal returns. Now, nominal returns, guys, nominal returns are the returns before the adjustment of inflation. If I want to deduct the inflation, if I want to adjust the inflation, so after adjusting the inflation from nominal returns, what do I get? After adjusting inflation from nominal returns, what do I get? I get the real returns. Understood? Now, in reality, see, nominal returns minus nominal return is real return plus inflation, correct? But we write it in compounding form. If they ask in exam, how do we write it? We write it 1 plus nominal return equals to 1 plus real times 1 plus inflation. Got it? Right? So arithmetically, if I want to find real returns, how do I do? Nominal minus inflation is real return. Correct? It's very simple. So if the nominal return is 10%, inflation is 2, real return is 8. Correct? However, in exam, we don't adjust like this. We adjust in compounded form. So if the nominal return is 10%, inflation is 2, real return is not exactly 8. Why? Because when it comes into compounding, how do we solve it? If I want to find nominal return, that is 1 plus nominal, 1 plus inflation, which is multiplied, comes on this side and becomes 1 plus inflation minus 1 gives me real returns. So now if you solve 1.1, 10%, divide by 1.02 minus 1, you'll actually get 7.84. 7.84 percentage, right? Here it would be 8 percentage only, because nominal I gave you as 10 percentage, inflation if I give you as 2 percentage. So arithmetically, it is very easy for you to understand, oh, the real return is 8 percentage. But in exam, you don't have to do that simple mathematics. You have to do it compounded way. And the answer will be 7.84. Everyone with me on this? Understood? Check. Clear? Anyone? Any questions? Hello. What should I do in exam? Yes, in exam, the equation is 1 plus nominal return equals to 1 plus real plus multiply by 1 plus inflation. Mostly they will ask you what is the real return. So we do 1 plus nominal divide by 1 plus inflation minus 1. Got it? So it's not exactly 8. It's not exactly the absolute way. Any questions? Anyone on this? Now, the last form of returns that you have in your syllabus is leveraged returns. These leveraged returns are, by the way, calculated in equity also, in portfolio also, in alternatives also, right? What are leverage returns? Now, there might be some correction in some of the books. I will discuss that. What is the correction? So first of all, it is R. R is the overall return times V0 plus VB plus VB. What is V0? It's your own funds and B is borrowed funds. Got it? So this is your overall return on the portfolio from which first of all, what will I do? I will subtract the interest. That is RB is the interest rate. Is the interest calculated on the whole funds or only on the borrowed funds? On the borrowed funds only. Therefore, if you notice, RB, that is interest rate, into VB. VB is what? The borrowed funds. So this is interest which is calculated only on the borrowed funds, divided by your investment, not the total investment. Your investment is V0. V0 is your investment. This gives you leverage returns. Don't worry, we'll see a question and we'll solve it. Everyone clear with this? Got it? Understood? Yes, anyone, any question? Okay. Yes. Okay, let's do these questions. Number 1. Stock purchased on January 2 at a price of 12. This is the beginning value. The investor receives a quarterly dividend of 0.6 per share. Okay, on April 1st, and the stock closes on June 30th at 13 per share. What is the holding period return? Now, holding period return is a simple return of the beginning value, ending value, and the income received during the period. Clear? So what is my HPR formula, everyone? My HPR formula is ending amount plus income divided by anything in the beginning minus 1. So yes, what is my ending value, everyone? 13 plus 0.6. So 13.6, I'm directly doing it, divided by the beginning value minus 1. Can you directly do it? 13.6 divided by 12 minus 1, you'll get 13.33. Everyone getting this? Simple, right? Correct. Everyone, hello. Check. Are you all there? Yes. Okay. Yes, some questions are very simple. Don't worry. Some questions might be tough. So we are not judging the question. Okay. Next, an asset manager's portfolio has the following annual return. These are annual returns, okay? Year-end returns. The manager states that the return for the period is 5.34% negative, right? So they have stated that the returns are negative. They have asked us that the manager has reported which returns? Arithmetic, geometric, or holding period. Now, let's try all of these. We'll have to try all of these, right? For arithmetic, what I'll have to do, I'll simply have to add all 3, divide by 3. So let's do 6 minus 37 plus 27, that is minus 4, divide by 3. I get 1.33. So is it arithmetic mean? No. Let's say geometric mean. For geometric mean, you need to compound, correct? So what I will do is that I'll do 1.06 times 37% from 1. So 1 minus 0.37 is 0.63 times 1.27. Okay. First compound these three. So 1.06 times 0.63 times 1.27. Now, what you get on your screen? Anyone can tell me on your screen? Yes. When you compound all three, 1.06 times 0.63 times 1.27, you will get 0.8488, 8481, right? Press YX3 inverse because it's 3 period, right? 3 inverse equal to, you will get 0.94 minus 1, you will get 5.34. Yes, so it's the geometric mean. Everyone. Correct? I'll repeat. First of all, on your screen, you get 0.84. Then what you need to do, first of all, I'll repeat again, 1.06 times 0.63 times 1.27. Friends, there is no minus. I see some of you all have said minus. It's no minus. It is 0.8481. So this whole stuff is 0.8481. As soon as you get this answer, press YX, then press 3, then press inverse. That will make it 1/3. Got it? Finally, what answer you get? -1 from all of this. And you will have your answer 5.34 when you multiply with 100. Everyone is getting this? Yes, no, yes, no, please tell me. Clear, 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 clear. Yes, anyone has any doubt? Right? Okay. Yes. So this is geometric mean. What about holding period return? Guys, in case of holding period return, all you have to do is not do 1/3. So you just need to simply compound this -1. That was your holding period return. Got it? Remember, this is HPR for multiple period. The only difference between HPR for multiple period and geometric mean is when you do to the power 1/n under geometric mean. Remember that? Correct? We did the same concept some 20 years back, right? Clear? I mean, 20 seconds back, 20 minutes back. Got it, everyone? Second question, anyone doubts? Let me know, otherwise I'll move on. Okay, let's go to the third one. Now, what is important? These might sound very simple questions. What I want you all to focus. Let me see, the recording is, yeah. Sometimes I tend to forget the recording is going on or not. Guys, what is important here? Sometimes students get confused. What is the question asking exactly? Okay, so while you read the question or I read the question, see to it that you get what they are asking. Okay. So here investor buys a stock for 200 at a time 0. At time 1, the investor buys additional stock for 225. So whenever there is multiple period information, all those who've studied from me, they know what I love the most is timeline. Okay, I'm anyways going to teach timeline when I go to the next topic. But since there are multiple cash flows, it's always better to have timeline. So here at the beginning, that is at time 0, they said you bought one stock at 200. So I can consider 200 negative. Why? Because it's an outflow. At time 1, they said you bought another stock at 225. So I'll consider 225 negative. Right? It already rings bell for me that it is multiple period cash flows. So this is either money weighted or time weighted. So now they have asked in this question, what are approximate time weighted and money weighted? They've asked me both. Okay, so we'll do both. Clear? Now, the third thing that they have asked is that at time 2, investor sells both the shares for 235. So at the end of second period, you sell 2 shares at 235. I'm doing 235 into 2. Why? Because I'm selling 2 shares. Here I bought 1 share. Here I bought 1 share. So those are my outflow. When I sell that, that's my inflow. Am I correct? Right? Correct. During both years, stock paid per share a dividend of 5. Both year means at the end of first year, I got 5 for 1 share. At the end of second year, I got 5 for 2 shares because by the end of the second year, I had 2 shares. Everyone understanding the cash flows? Clear? Yes or no? Now, remember what I told you from the notes that whenever we are doing money weighted return, you need to think from the cash flow point of view. So what is important is that I see the cash flow here. What is the cash flow here? In the beginning year, CF0, I call it CF0. This is year 1, this is year 2. What are the cash flows? Everyone can help me. What is the cash flow here? Minus 200. Here it is minus 225, but you got $5 dividend. So can I say it is minus 220? Minus 225 plus 5. Dividend is an inflow. 225 was investment. And in the second year, 235 plus 5, that is 240 into 2, I'll get 480. Everyone is understanding the cash flow. Are you all with me on these cash flows? Yes or no? Yes or no? Yes or no? Yes, everyone is understanding the cash inflow outflows. Correct? Because if everyone gives me a green signal, then I will go to the calculator. Clear? So for money weighted rate of return, what I need to do is that I will go to the calculator, and now there is a cash flow function below enter. Press that CF0 and press second and clear. Clear is on the bottom. Second clear. Now that is to clear the previous numbers, or I call the previous karma, but you can do it twice. Second clear, just to ensure that there is nothing already out there, because sometimes there are some previous numbers and they will disrupt your answer. Everyone with me? Cash flow function, right? Now, what was our CF0 check? Our CF0 was 200 negative, C01 was 220 negative. So 200 negative sign is on the bottom. Enter. C01 was 220 negative sign. Enter. Go to C02. Skip that F. F stands for frequency. Skip it. C02, second year cash flow. What was the second year cash flow? 480. 480 was the total, right? So 480, enter and press down arrow. And you already know money weighted rate of return is nothing but IRR, correct? So all the cash flows we've already put. All you need to do is that there is a function called IRR above PMT. Press IRR and press compute. Press IRR and press compute. You'll get 9.39 or approximately 9.4. Everyone with me on this. Clear. Now see, this is our money weighted rate of return, right? Now they've already asked us time weighted and money weighted, and the second is money weighted, and we already got money weighted, which is 9.4, which is unique, which is not there in B and C. So definitely, without even wasting time in exam, if I get these choices, I can directly go on selecting A, because B and C doesn't have money weighted as 9.4. However, I will also show you how to do time weighted here. Everyone with me? See, while doing money weighted, what was in my head? I told you, while doing money weighted, how you should think. You should think it's a cash flow. While doing time weighted, you have to focus on holding period returns. Ignore the cash flows. Doesn't matter. Focus on the returns on the stock. How much is the holding period return here during this period? And holding period during this period. Also, it doesn't matter how many stocks you've bought. Tell me one thing. The percentage return on the stock, whether it's a single stock or 10 stock, does it matter? How much percentage did you earn, whether it's a single stock or whether it's 10 stock? Does it matter how much percentage profit you made? Please tell me, everyone. Does the percentage return matter whether it's one stock or 10 stock? Well, the percentage return doesn't matter at all. So two things you should do. You should ignore the cash flow concept when you're doing time weighted rate of return. You should focus on the holding period return, and you should ignore how many shares you have. Now think of the holding period return. What is our holding period return formula? Ending plus income divided by beginning. So what is between the 0 and 1? Only focus on between 0 and 1. What is going to be your holding period return? What is the ending value? 225 and income of 5. Correct? Now don't look at the sign. Think of like a holding period. Don't look like a cash flow. So in your calculator, 225 plus 5, ending plus income, that is 230, divide by 200 minus 1. This will give you how much? Yes, anyone? 15%. Yes, don't fall into the trap of signs. Signs we did for cash flow. Clear? Understood? Now this period return is gone. Look at the second period. The second period starts from at the end of first year to the at the end of second year. Doesn't matter how many shares you hold. What happened to the stock? The stock was 225. Dividend 5 was of the previous period. So that's gone. So 225, it ended at 235 and you got 5 dividend per share. Focus only on one share. It doesn't matter whether it's 2 share or 20 shares. So again, if I do ending value, what is my ending value? 235 plus 5 equal to 240 divided by what was the previous year value? 225. Divide by 225 minus 1, you'll get 6.67%. Are you getting this, everyone? That's your 2-period HPR. Everyone is getting this? Yes, 6.67% for the second period. Correct. Now you need to compound both the returns. How do I do that? Same like annualized return, geometric mean. For geometric mean, I will do 1.15 into 1.0667 to the power 1 over 2. 1 over 2 is nothing but square root minus 1. So this times 1.15 into 1.0667, you'll get 1.2267. Since it's to the power 1 over 2, you can simply press square root minus 1, you will, and into 100, you will get 10.75, which is approximately 10.8. Let me know if you're getting these returns. Everyone? Time weighted rate of return is geometric mean. Money weighted rate of return is from the cash flow point of view. There is a very high chance that this type of question will be asked in exam. Did we add 5 to the minus 225? See, again, I will repeat here. Your question should be specific. Are we thinking from the cash flow or time weighted? If it is time weighted, what is holding period return formula for first period? Focus on the HPR formula. It is ending plus income divided by beginning. So in the first period, what is your ending value? To the one who asked the question, what is your ending value? Please repeat. 225. What is your income? 5. 225 plus 5 divided by beginning. 200 minus 1. Don't look at the sign. Don't look at how many stocks. Think of HPR. Are you with me? So 225 plus 5, that is ending plus income divided by beginning. Did you get the answer? Hello, hello. Yeah, to the question. Second period, in the second period again, I look at the stock, not at the cash flow. So what was the stock's value at the end? 235, ending value plus income of 5. In the second period also, the stock gave a dividend of 5. And the beginning value for that period was the ending value of the first year, that is 225. Clear? Again, I'll repeat, see, when you're calculating time weighted rate of return, do not look at the sign. The signs were done for money weighted rate of return. If you look at the sign, you'll get confused. Signs are only for money weighted rate of return. When you are looking at time weighted rate of return, ignore the signs, ignore the number of shares. What do you require in HPR? What is the beginning value? What is the ending value? And what is the dividend? And then follow the formula. What is the formula? Ending plus income divided by beginning. If you go to the sign, you're confusing yourself. Signs are cash flow signs. They are only required when you calculate money weighted rate of return. When you calculating time weighted rate of return, I'll once again repeat, ignore the signs, ignore the number of shares. Clear? Understood? Everyone? Got it? Yes, very crucial question. Let's move to the fourth one. Now, this is one of my favorite questions also. Okay. Let's see. Over a period of 1 year, investors' portfolio has declined in value from 127,350 to 108. What is the continuously compounded rate of return? Now, remember the formula for continuously compounded rate of return was log natural 1 plus HPR. Correct? But can you tell me what is HPR? Holding period return. Again, it's ending over beginning minus 1. But when I do 1 plus HPR, all you have to do is ending over beginning. Correct? So log natural of 1 plus HPR is nothing but log natural of ending over beginning. Correct? So what is log natural of ending value? What is the ending value? Decline in value from this to this. So the ending value is 108 and the beginning value is this. So definitely it's a negative return. So what is the ending value? 108,427 divided by the beginning value 127,350. First in your calculator, put this 108,427 427 divided by 127, 350 equal to, you'll get 0.85. Press ln. As soon as you press ln, you will directly get the answer, that is 16.086, which is nothing but B. Everyone is getting this answer? Clear, clear, clear. Understood? Anyone has any questions on this? Okay, the class is a bit cold. Come on, where's the energy? First day energy. Come on, come on. Don't tell me you are working so hard on the field that you're tired. Come on, everyone, CFA. Let the energy be there 100%. Okay. Next one.
Please zoom
Yeah.
in.
Yeah, sure. Now, perfect. Now, next question, computing the internal rate of return of the inflows and outflows of the portfolio would give us what? Yes, IRR. See how they ask questions. It's not only practical always. IRR, which one of these is IRR? Yes, money weighted rate of return is also called IRR. Clear, 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 everyone? Easy, easy, easy. Next, assuming at least some variations in a set of data. Everyone got it, right? Yes. Next, assuming some variations in a set of data, the geometric mean is greater than arithmetic mean, which is greater than harmonic. Now see, let us understand that when we analyze the, for basically this question, actually I need to give you an example so that we can understand. So what I'm going to do is that there is an example of harmonic mean. We can take that example and I can explain you how all three are related. Okay. See, can you go to the 10th question, the last question here? Everyone, before we solve it? Yes, everyone? Correct. In this question, they have asked us what is the harmonic mean of these values, 12, 14, 11, and 9. So there are four values, right? So to calculate harmonic mean, all I need to do is 4 divided by, I need to do 1 over 12 plus 1 over 14 plus 1 over, 1 over 11 plus 1 over 9. Now, how do I solve it? Okay. In your calculator, all you are going to do is 12. First press 12 and then inverse it. Where is inverse? 1 over x. You'll get 0.08. Did you get it? When you inverse 12, 1 over x. Are you getting it? 0.08, everyone? Store 1. Store 1. Everyone knows what is the store function. I've met so many candidates who told me, Kunal, we never knew store function. Is there anyone who doesn't know the store function? Yes, 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 yes. Let me show you how to store it. Okay, for those who probably don't know, and it's okay if you don't know, because for everyone it's some of them it's for the first time. So see, 12, I did 12, right? Then you do 1 over x, you get 0.808. You need to store. Where is store? Just besides 4, sto 1. So we store in the box. Correct. Same way we have 14. Then I sorry, my mistake. 14, 1 over x, store 2. Correct. Then we have 11, inverse, store 3. Then we have 9, inverse, store 4. Now, when I want to add all 4, I press recall 1 plus recall 2 plus recall 3 plus recall 4 equal to. Are you getting this answer? Correct. You can store this also, store 5. Now, sometimes some people store it, some people can skip it. If you store it, you have to do 4 divided by this. 4 divided by recall 5. Or what I simply do is, since it's in the denominator, I do 1 over x into 4 because there are 4 investments. So I get this directly. Are you getting this answer? 11.21. Everyone, please let me know. 11.21. Correct. Yes, that's my harmonic mean. In this case, the answer is 11.2. The closest of all the three is C. Correct? Everyone understood? How do I do that? The technique, the individuals, we inverse it, store it. Then 4 divided by all 4, the summation of all 4, or you can simply sum it up, inverse it, and multiply with the numerator. Can you raise hand or drop me a text as to who all are seeing this for the first time? This technique of doing harmonic mean, or everyone is used to? If everyone is used to, great. Great. Okay. So that's your harmonic mean, right? The answer is done here. But what if I told you to calculate arithmetic mean of the same number? How do I find the arithmetic mean, guys? Simply add all 4 divided by 4. So let's do 12 plus 14 plus 11 plus 9 divide by 4. You will get 9. Clear? Are you getting 9, everyone? Yes. And what if I told you to do the geometric mean? So the geometric mean compounded 1.12 times 1.14 times, imagine these are all returns. 1.11 times 1.09 equal to, I get 1.544 to the power 4 inverse minus 1. I'll get 11.49. 11.48, sorry. I'll again do it. 1.12 times 1.14 times 1.11 times 1.09 equal to the power 4 inverse minus 1. You'll get 11.485. 485 or 49. So there is some problem with the arithmetic mean. Let's check it. What is the arithmetic mean? 12 plus 14 plus 11 plus 9 divided by 4. Sorry, it's 11.5. Slightly different, right? 11.5. Everyone right? Correct? AM is 11.5. GM is slightly less, 11.49. Harmonic is the lowest. What is the relation that you discover here, guys? Amongst all three? AM is always greater than GM, which is greater than harmonic mean. If the numbers are different, if they are all same, then they all are going to be same. Correct? But this relation will always be there. Arithmetic mean is always bigger than harmonic, than geometric, and geometric is always bigger than harmonic. Yes, harmonic is always the smallest. Clear? So the reason we did this so that we can answer question number 6. In question number 6, they asked us, assuming at least some variation, means the numbers are different in a set of data, what should be my answer, everyone? For the 6th one, 10th one we did, right? For the 6th one, what should be my answer? Who should be, the first choice is geometric mean is greater than arithmetic. Is it possible? No. Harmonic is greater than geometric, correct? Which is greater than arithmetic. Harmonic is greater than geometric? No, it is the least, right? So second is also wrong. Third, arithmetic mean is greater than geometric, correct? Which is greater than harmonic. Yes, arithmetic is greater than geometric, which is greater than harmonic. Understood, everyone? Clear. Everyone? Option C. Everyone with me? Next, I'll move to question number 7. Clear? So we did that question so that we can relate this. Which of the following is most accurate with respect to relationship of the money weighted and time weighted? Remember when to use money weighted and time weighted? This is a very important question. If the funds contributed to portfolio just prior to a period of favorable performance. See, when you put the funds, okay, so there is an inflow and outflow. Okay. If there is an inflow and outflow, who gets affected, money weighted or time weighted? We learned it in the notes. Who is sensitive to cash inflow outflow decision, guys? First of all, tell me, everyone, who is sensitive? You have the notes with you, everyone. Money weighted. See, check in the notes. Who is sensitive to cash inflow outflow decision? We are going to solve this without calculation. Money weighted is sensitive to cash flow, right? So money weighted gets affected, time weighted doesn't get affected. It is not sensitive. Now, they told us if there are funds contributed just to a period of favorable performance, means just before a bullish period. Everyone understands what is bullish? What is bullish and bearish? Bullish means when the market is going to go up. Bearish when the market is going to go down. Why it is called bullish and bearish? Because bull always attacks with the thorns on the upside. Bear always attacks downside. That's why it's called bullish and bearish. Haha. Yes, it's a fact. So bullish, when the markets are bullish, just before that you put funds. Good decision, bad decision. Just before the bullish market, you put funds. Good decision or bad decision? Everyone, first tell me. If the funds are contributed to the portfolio just prior to the favorable performance, means just when the market was going to take a flight upside, you put in more money. Was that a good decision or a bad decision? Everyone in the class should tell me. Everyone is fund manager. It's a good decision, right? So this good decision will give me higher returns, isn't it? But these higher returns will be reflected in money weighted or time weighted. Where are these decisions of cash inflow outflow visible? In money weighted or time weighted? In money weighted, right? Money weighted gets affected with cash flow. So the decision was good. Who's going to get affected? Money weighted. So money weighted return will be higher than time weighted. Everyone agrees with me? Clear, clear, clear. So my answer in this case is going to be money weighted rate of return will tend to be depressed. No, it will tend to be elevated. Yes. Elevated means it is going to be relatively higher. But what if I had put investment just before a bad period? Then money weighted rate of returns will be less. Correct? Do you want to see something interesting? Do you want to see this proof? We actually did it. We actually did it. See here. Which period returns were better? First period or second period? In this question that we did, which period returns were better? Period 1 or period 2? Period 1, you got 15%. Period 2, you just got 6.67. I'm not saying it is negative, but it's lesser than the first period, right? So second period was underperformance, right? Just before the second period, you put in more funds. Remember the story told you that you bought one more stock at the end of first year. So here you put more funds before a underperformance. The best performance was in first period. Second period was less performance. Good decision, bad decision. Good decision, bad decision. Come on, tell me. Just before the second period, which was bad performance compared to the first period. I'm not saying bad, but compared to the first period, you bought one more stock. So you put more funds. Was that a good decision or a bad decision? Everyone in the class should answer. Come on. All of you are fund managers working for the biggest sovereign wealth fund on this planet. Yes, it's a bad decision because you put more money before the bad period. Yes or no? Everyone agrees? Tell me. Yes, so it was a bad decision. Now, this bad decision will be reflected in money weighted or time weighted? Money weighted, because that gets affected by cash flow decision. So my money weighted rate of return should be less. Check your answer. Your money weighted rate of return was 9.4. Time weighted rate of return was higher. Are you able to now understand the concept? With calculation, without calculation, everyone? Got it. It will put some stress on the concepts, but see the relation. See the relation here. My money weighted rate of return was less because it gets affected by my decision. Was my decision good here? No, it was a bad decision because I put more money just before the underperformance. Had the second year return been 16%, then my money weighted rate of return would be higher than time weighted. Understood, everyone? How was it? MWRR, TWRR concept, calculation, technique, all three we need to know. We need to know the concept, we need to know the calculation, we need to get our answer correct, and we need to know the technique. All three check boxes we need to click. Clear? So number one thing, who gets affected by the cash flow decision? Everyone, money weighted. Okay. And if you are putting more money just before the bad period, then money weighted will always be lower than time weighted. Clear? Understood? Okay. Let's do the next question and let me see how you apply it. Okay. Investor makes the following investments. She purchases a stock for 50. After 1 year, she purchases additional for 75. After 1 more year, she sells both the stock at 100, no transaction. Stock paid a dividend of 5 per share. In year 2, the stock paid of 7.5 per share. Her required rate of return is 35%. That doesn't matter. They are asking money weighted rate of return. So for money weighted, I need to put everything in the cash flow. Everyone agrees with me? Put a timeline. Okay. See, the first couple of sessions, it might go very slow. You might be wondering, when will we finish? When will we finish? Guys, don't worry, when will we finish? Do you want to finish anyhow? No, right? You want to finish it with form of the concept, right? So don't worry about the time. So let's plot everything in the cash flow here. So period 0, during 0 period, stocks, she purchases stock for 50 minus 50, think from cash flow point of view, okay? Not holding period. At the end of the first period, what happened? She purchased another stock for 75, correct? And one more, after 1 more year, that is at the end of second year, she sold both the stocks at 100. So 100 into 2, clear? Plus. And then they said, during the first year, the stock paid a dividend of 5. So this is plus 5, right? And in the second period, the stock paid 7.5 per share. So I will do 7.5 into 2. Everyone understanding this? So what's my cash flow here? Here it's minus 50 CF0. Here it is minus 70 C01. And in the second period, it's going to be 215, correct? 215. 215. This is going to be your C02. Everyone with me on this? CF0, C01, and C02. 100 plus 7.5 into 2. Everyone, go to the cash flow function. Clear, second clear. Put CF0 as negative 50. Enter C01. C01 should be 70 negative. Enter. C02 should be 215. Enter. Press IRR compute. You should get a very big number. Surprise me with the number. Everyone is getting 48.86. That is 48.9. Yes, yes. Check, 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 check. Let me know. Let me know. Let me know. Yes. This information, required rate of return 35%, doesn't matter. Ignore it. Unnecessary information. Clear? Got it? Done? Okay. Let's move to the last question. 10th we've already done. Selmer Jones has inherited some money and wants to set some of that aside for a vacation in Hawaii 1 year from today. His bank will pay him 5% interest on any funds he deposits. Okay, in order to determine how much money must be set aside for and held for the trip. Basically, he wants to know what should be the present value. He should use 5% as. So suppose he needs $10,000 for his vacation, example, after 1 year. So actually, this is a question of time value, not this, but somehow they've put here also. I want to know how much should be the money that I should keep aside today so that it grows at 5% and becomes 10,000 at the end of first year. So I need to find the present value of it, correct? So what should I do? They've asked it. He should use this 5% as discount rate, opportunity cost, or required rate of return. What? They all sound similar, but this 10,000, I need to find the present value of 10,000 to be invested today, right? So to find the present value, what do? We discount the 10,000. That's why this 5% in this case becomes the discount rate. Understood? Clear, clear, clear. Anyone has any questions? Let me know. Check, check, check. Correct? This is the way we do the concepts. we do the questions. Okay. Anyone? Right? See, the second topic is time value of money in finance, which we are going to touch upon, but that's a very small topic. And then again, we'll do this questions related to that. First two topic actually has a lot of variety of questions because they've actually mixed up everything from here, there, and everything. And many of the students have the issue. The reason I'm going slow and in depth about all of this is so that you do not face those issues when I go to fixed income and equity. At that time, you're not wondering what is this calculator function, how to use it. At that time, everyone is at par with me. Everyone understood? If yes, ping on the chat box. If no, don't ping. If you don't ping, I'll get to know, okay, you didn't understand, right? 1, 2, 3. Oh, only 3, 4, 5, 6. Ping, ping. Okay, correct. Yes, yes, yes. Who's this Zoom user? Please use your real names on Zoom, or your Hollywood names also you can use. Yeah, okay. Everyone clear? Understood? Right, 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 right. Okay, correct. Okay. Now, just a moment. Okay, so this is where we complete our reading number 1, and then we'll proceed to the reading number 2. Perfect. Thank you.